You've been warned. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, this change will affect every American household and is coming in less than 2 weeks. I'll show you what it is and why its timing couldn't be worse for the U.S. economy. And something that's changed my household and could change yours is making money trading. I'll show you how in the last month I've made almost 7% on my trading using my own reports. Stay tuned. Now let's head over to Bloomberg, where he picked today's story up with a headline: as U.S. finalizes China tariff increases, and Biden announced back in May, and here it comes, more increases in the cost of goods coming into America. And this is something that's going to affect every household at a time when we continue to hear from the data from consumers saying that inflation's too high and wage growth is too low. The timing of this couldn't be worse, as we're already now in the early stages of a recession. The Office of the U.S. Trade Representative made a final determination on the proposed increases that Biden announced in May that include a 100% duty on electric vehicles, 50% on semiconductors and solar cells, and 25% on battery parts and many critical metals. Most of the increases will take effect in less than 2 weeks on September 27th, with those on computer chips next year and natural graphene, a critical mineral for EV batteries, not until 2026. The changes will affect about $18 billion in annual U.S. imports, and this is just going to drive up costs more for U.S. consumers. But if you think about why this is happening, it's to protect American jobs at a time when we're seeing more and more Americans start to hit the unemployment line. And tariffs are a key issue on the 2024 campaign trail ahead of the U.S. election in November, as polls consistently show that more voters trust former President Donald Trump to manage the economy. And former President Trump has touted tariffs as a way to protect the U.S. and spur manufacturing. He's floated a sweeping 60% tariff on Chinese goods if reelected in November, and a 100% tariff on countries that shift away from the U.S. dollar. Meanwhile, Vice President Kamala Harris, who became the Democratic candidate for the November 5th election after Biden withdrew in July, has said this proposal will be a Trump sales tax that would raise prices for middle-class families by thousands of dollars. Trump countered by pointing out that Biden administration left in place the duties that he imposed in China. I want to know what you think. Do you think we should put on more tariffs? Do you think these tariffs are a good thing? Where do you stand on this issue? Weigh in the comments below, because when we talk about U.S. manufacturing, is the issue really here about tariffs? Is it it's about jobs? But the problem is the people here in the country cannot afford higher prices, and we see that evidence very clearly here when we look at manufacturers' new orders of durable goods. This against total compensation growth, which is expressed as average hourly earnings multiplied by average weekly hours of production and non-supervisory employees. That's shown in red in both on a year-over-year rate of change. So what you see here is, as total compensation growth slows, well, demand from consumers goes down as well, and you see new orders from the manufacturing sector decline. You see that happen going into the dot-com bubble, and it repeated again in the global financial crisis, which again, a lead of total compensation growth slowing led to decreased demand. We see that now as everything continues to slow down. But one of the issues we have is people don't understand how the global monetary system works. See, we are the global reserve currency, and that means the dollar needs to flow outside the U.S. to other parts of the world. And say when it goes to China, it comes back to the U.S. in the form of they usually buy our debt and other things. And that's how money flows around the global economy. And one thing Americans benefit from this is by the cheap import of goods and services from foreign countries. Now, the sacrifice is the labor market. The problem is, if you move to protect the U.S. labor market through the use of tariffs, well, then you constrict the export of dollars. You actually constrict the global economy from growing, and then you start to see a move away from the dollar. It's a dangerous game, but on one side, I get the game here. You want to protect manufacturing jobs, but the problem is, due to the cheap import of goods from other places, that means it opens the door for U.S. consumers, which is a huge benefit, to spend money, excess money, on other parts of the economy. You raise the prices in one area, it leads to less money in another, and ultimately fewer jobs. This isn't something I'm sure I agree with, but we get why they're raising the tariffs on EVs. no one's really buying them, and there's a lot sitting on dealer lots right now. The last thing we need is more of them here, but this is a dangerous path we're going on. But again, I'd love to get your opinion. What do you think about tariffs? Weigh in the comments below, because U.S. consumers are on the edge about their income, retirement in the latest data. This from the University of Michigan. But if you're worried about your income, you can start making money trading just like I'm doing. How did I do that? I've been watching our reports looking for something that I thought was going to be a huge win, and showed up on our CTA Time Pro report back a month ago. Now currently we have 6 open trades. Actually 5 of them are up. That's a typo. We're sitting on an 83% win rate. Talk about putting confidence when you're trading. We added 2 new trades for our subscribers on Monday. Right now we're not seeing a big shift in momentum, but we're seeing a shift in machine positioning. But how did I have the edge? Well, one of those ways is we did a full back test on CTA Time Pro. We know which signals have the best probability, the highest potential for a positive return. And here's what you get. You get the daily report. You get all the signals, and you can pick from them the ones you want, because I give you my opinions on the ones I think you should look at. I give you stop loss levels. I track all the trades. I track the returns for you. And every Saturday we update the stop loss levels. But here's the best part. You get a 30-day free trial, no matter which report you pick, or both. And on top of that, with CTA Time Pro, you get the back tested data. It's there for you to download. We're working on the Momentum Time Pro data, and this gives you the edge. You want to make money trading. Again, you don't have to trade every day. I just trade occasionally and put up some big returns. Right now, check out those links in the description below for that 30-day free trial, because Americans have been financially stressed from a higher cost of living and elevated borrowing costs, and a topsy-turvy election year that is contributing to plenty of uncertainty, this according to the latest data from the University of Michigan. But the issue here is many believe that consumers aren't spending because of the election. I don't think that's the case. I think they would spend anyways. I believe the issue is, just as it pointed out, that higher cost of living and elevated borrowing costs are keeping people on the sidelines because their incomes are not keeping pace with the cost of goods. And this is something that continues to show up in the surveys. And this is one of the reasons I'm having a bit of an issue with, let's add on more tariffs, because the timing of this, if you think of this from the average American household, the last thing they need is prices to go up. And we know that's generally what happens. And while consumer sentiment picked up to a 4-month high early in September amid expectations of tamer short-term inflation and the Federal Reserve interest rate cuts, the gauge of current conditions is still near the lowest level on record, meaning consumers are not confident about the economy, and when they're not confident, they don't spend. And that's why I don't think tariffs here are going to be any value to the economy, because consumers, if they see prices go up or they see it even more difficult to go out and spend money, they're just not going to. But the sentiment survey already indicates that they're not inclined to spend. And of course, we know when consumers stop spending, that means wholesalers, retailers alike, they see demand go down, they start cutting hours, they start cutting employees, and next thing you know, we're right on the path to a recession. And there's good reason that consumers aren't confident, because it comes back to the labor market. Their wages aren't keeping up, spending's not keeping up, and that means more Americans hitting the unemployment line. And you can see that very clearly by looking at the University of Michigan Consumer Sentiment Survey in blue against the unemployment rate. As you see the unemployment rate rising in red, what happens is confidence in the economy, sentiment. It goes down each and every time. This time, Americans bought into the soft landing or no landing scenario that the Fed said they could achieve. Right now, it doesn't look like it, and this continued rise in unemployment levels here are telling us that confidence is going to come plummeting down. Spending is going to go away with it. The timing of adding more tariffs here isn't going to do the U.S. economy any good. We need something more substantial to get consumers to go out and spend. We need wage growth to go up. We need interest rates to come down. The question is, will it happen fast enough? Well, the odds are it won't. Because a wide variety of topics in the university survey show that the present level of unease among Americans is now at historic levels. The current environment even supersedes the level seen after the Great Recession or the immediate post-pandemic period in some measures. And again, why is that? It has everything to do with the labor market, but it also has something to do with household finances. And this is an issue here, because look at this. We talk about delinquencies, and we're going to talk more about this here in a little bit. because the delinquency rate on credit cards also tells us when consumers are not confident, because if they can't pay their bills, well, they certainly can't do other things. Here you can see back in the mid-90s, delinquency rate rises. What happens? Consumer sentiment slows down and dips a little bit. You see it happen again at the dot-com bubble. You see it happen here at the global financial crisis. A huge rise in delinquency led to a plummeting confidence in the economy, and now you're seeing it happen again. Consumers are falling behind. They want to believe the economy was going to turn in their favor, and the problem is it didn't. In fact, now they realize it's going to get worse, and they're sitting on massive amounts of debt. They're sitting in an economy that they can't afford goods and services. It's a dangerous game. And while the pace of inflation is cooling, prices remain much higher than before the pandemic. The Consumer Price Index has surged 21.5% from the end of 2019. While incomes have also increased, consumers still say they're not getting ahead. And that's the issue. You want consumers to be confident, they need to feel like they're getting ahead. And when they don't get ahead, well, it tends to actually foreshadow a recession. Let's take a look at total compensation growth. Again, this shown in red against the Consumer Price Index in blue. And what happens when you see the Consumer Price Index get ahead of total compensation growth? Consumers fall behind. You see a gray shaded bar. There's your recession showing up there in the early 90s. You see it happen again here at the dot-com bubble, happens once again at the global financial crisis, and we almost had a recession. We almost had a double dip recession around 2012, but we somehow escaped it. One of the few times it happened, and look now, this big increase of consumer prices against slowing total compensation growth. Consumers all around the country got behind, and despite the fact that the government now says, wait a minute, you're ahead, they don't realize that they are playing catch up and they're getting behind. That's the issue here, is they never got caught up with the economy, and now they're facing rising unemployment. It's dangerous because now consumers believe their wages aren't going to go up, and for good reason. We see no income growth after inflation in the coming 5 years now stands at the highest on record. And here's why: because when you look at the unemployment rate against just average hourly earnings of production and non-supervisory employees, that's shown in red on a year-over-year rate of change. You see almost a mirror of the two data points, because it's very clear. As the unemployment rate rises, well, employers don't need to give out as big of raises, so they don't. And that means people fall further and further behind inflation. You start to see why consumers aren't spending, why their confidence is starting to plummet here. It has everything to do with the economy. And again, we come back to where we started the show. I'm just not sure that tariffs on EVs is the right answer at this time. But even as stock prices approach a record, the odds of a comfortable retirement at the lowest level since 2013. Not all Americans are investors or have retirement accounts that benefit from surging equity prices since the pandemic. But here's the thing, you can take advantage of it, because I give you the tools to be confident when you put your money and invest it. I give you all the probabilities you need to be a successful trader, to put all the edge in your side of the table. Take a look at those links in the description below, because you see things getting worse. And look at this, we go back to last week. Ally Financial craters after auto lender reveals surging delinquencies and charge-offs. This is dangerous. And here we can see a dramatic crash in the shares of Ally Financial, which plunged as much as 18%, their biggest one-day drop since March of 2020. And what sent the stock crashing is CFO Russ Hutchinson warning about weaker credit and net interest income trends quarter to date relative to expectations, specifically saying that in July and August they saw auto delinquencies soar a whopping 20 basis points compared to their expectation, while net charge-offs were up 10 basis points compared to their expectations. Meaning what we're seeing in the economy is that U.S. households are falling further and further behind. We're clearly headed into recession now, and it makes perfect sense. Wage growth isn't keeping up, sentiment data is plummeting, and delinquencies are on the rise. And confirming the pain is mostly linked to the firm's retail auto loan book. Hutchinson said borrowers have shown signs of vulnerability throughout the year, and the August U.S. jobs data underscored those stresses. What's really happening here is workers are getting less hours. They're not getting the big pay increases they were before, and they're looking around and seeing that their job is coming at risk because new orders are down. backlogs are going away, and inventories are rising. They just can't meet their bills anymore. That's why they're heading to delinquency. This is only the beginning, because over the course of the quarter, our credit challenges have intensified. Our borrowers struggling with high inflation and cost of living, and now more recently, a weakening employment picture. There you have it. And commenting on the announcement, a KBW analyst, I get this, he said, clearly the guide was disappointing and begs the question if this is Ally specific or a canary in the coal mine. The answer is it's a canary in the coal mine. This is something nobody expected, and we've been warning that this was going to happen, that when you constrict the creation of credit in a debt-based economy, there's not enough money to pay on all the debt and achieve your growth targets. When that happens, you start to see delinquencies building. Next thing you know, they go into default, and now after that, we're in an all-out financial crisis. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.